Matt, good to see you. I'm excited about today's topic. We are covering day trading, the risks and the rewards, fueled by COVID lockdowns, of course, and the rise of commission-free brokerages like Robinhood. Online trading or day trading. Day trading has seen a huge increase in popularity. Take a look at these new accounts created on E-Trade. And also now there are these influencers peddling courses or video series promising to unlock the secret windfall to profits. However, according to recent financial studies, almost all day traders lose lots of money, particularly after accounting for fees and taxes. So, Matt, of course, so self-directed investing offers potential cost savings and learning opportunities. What are the other advantages?
Well, I think the benefit for most people is it's entertainment. It's enjoyable. You get excited. Realistically, for most people, it's the risk is similar to gambling, depending on what you're purchasing, of course. But other than that, the fees are lower and it's enjoyable. Beyond that, I think those are the two main benefits.
Yeah. Okay. So I was surprised to learn this. The same studies found that only 1 to 3% of day traders consistently earn above market returns. Why is that?
That's a good point. And the key being above market returns. It could be 1% above market returns, and yet you're
Mhm.
living your life, sitting at a computer all day, or however have it set up. The reason is simply because people get wrapped up into the retail news, which is all they have access to. And the retail news on the market is often wrong. For example, coming into this year, the retail news was saying we're going to have a recession at the beginning of the year. And obviously, it's been the reverse of that. So, number one is they get wrapped up into the wrong news. Where are they getting their advice? I think it's a big question. And with that, they buy at the wrong time. So they're buying at the optimism scale here, and then they're selling, when they start getting into the fear stage, but they're selling the losers. I'm sorry. Yeah. They're selling the winners and they're holding on to the losers
Right.
because people have a bigger fear of losing than the greed factor. Right. So they hold on to the losers and they sell the winners. That's just all it is.
Yeah, behavioral finance. It's tough not to act like a human when we are humans. So,
Exactly.
if people though do want to open an online account, we're going to walk through some considerations first. And the first consideration that you recommend is you have to know your approach and expectations. What does that mean exactly?
I think the big thing here is you look at your risk tolerance. Are you a conservative investor? Are you an aggressive investor, somewhere in the middle, moderate? And it's easy to be in upmarket. People tend to be a little bit more aggressive. But how did you feel in 2022? Right? How did you react? If you really reacted and you're really concerned, you might have been not invested as per your risk profile. So,
Mhm.
for example, if you're a conservative, that means 10 to 20% of the gains or losses. If the market's up 10 to 20, you're going to gain 2 to 4. If the market loses 20, you're going to go down, 2 to 4. So that's a
Mhm.
conservative investor. You just want to make sure that you understand your risk tolerance and your investment
Yeah, because
really
day
overall.
trading is almost always very aggressive,
Oh,
right?
extremely. Yeah. Yeah.
And then the second consideration, of course, consider the risks, two specific risks. You touched on behavioral finance. The other one that we want to let people know about tax implications. There's so much I think that the average investor doesn't know about, these taxable events when we're moving money.
Yeah. So anything held in a non-qualified account that you hold for less than a year is going to be your income tax rate. So 35% if it's a big gain. And that also includes whatever wage income you had for that year. So you're going to have a big tax, on the federal level. And then also, if you live in a state that has income tax, then, there as well. If you hold it for more than a year, it's between 0 and 20 based on your income. It'd be long-term capital gains rate. For most people, it'll be 15%.
Okay, well, this was interesting to talk through. I think, as long as we consider it our fun money, maybe
Exactly.
that's the best way to go about
Yeah,
it. But
nothing wrong with having fun money. At the same time, I see so many people that I say it's base hits versus home runs.
mhm,
Aaron, if you put 500 away for 30 years and you get 10%, that's $1 million.
mhm.
My concern is I see people just putting everything into the home run and nothing in the base hits. And those are high risk stocks, and you have a chance of losing everything. We don't want that.
Right. No, not with your retirement savings. Absolutely. Matt, if somebody has any questions of something we've covered, what's the best way to reach you?
The best way is by phone, 425-256-3105.
All right. And we've also got your website, choosevault.com. Matt, thank you so much for your time today. I appreciate it.
Thanks, Aaron.